Thank you. We can kick off. I hope not to keep you much longer. I want to quickly recap some of the key issues, recurring issues that have come up during the, really primarily the October filing. To highlight the amendments, some very generally cosmetic amendments, the way things look have changed slightly, and that will be in the XBRL template version of Excel file that I will send to you this afternoon or tomorrow morning. Just go through those, and then just to wrap up with the process and the logistics. So under general, the submissions in the parallel run do not need to be signed off. Once the process is up and running in its entirety, it runs, as you've seen, in ESS. So your electronic signature suffices as the sign-off. So in effect, that portion that you are now rendering in XBRL will be signed off. We don't expect you for the Excel files portion to send us a submission that is signed off in a PDF or whatever. That's not required. These are not yet the statutory returns. Many people have asked, what about the audit requirement? This set of returns during the parallel run is not subject to audit. We will be kicking off another project to agree what assurance, what level of assurance, what form of assurance is required for different forms. That will be discussed with the audit profession, and you will be kept informed of that. That is only applicable from December 2014 year-end or March 2015 if you have a March year-end. So no audit in respect of these December returns by way of example. There are no annual returns in the same sense as what we currently have. There are certain returns that we require, yes, on an annual basis, but they will, in all probability, not even have an XBRL aspect to it. They generally relate to governance issues, shareholders, group structure, annual reports. Those won't be in XBRL. Some data, maybe one or two pieces we will ask for in XBRL, but they're not applicable yet. They will again only be applicable December 2014. It has been mentioned that numbers must be rounded to 1,000. We do not, you will not be able to enter any decimals. We don't want any decimals. We only want thousands. And you can not enter negative numbers. In other words, when you enter provisions, it's entered as a positive number. The file treats it and calculates it by deducting it. All values entered as positive. Obviously, there are certain values on the income statement that can be negative. Those cells are open, and you can enter negatives in those cells. But you cannot enter negatives in other areas. Not applicable to our audience today, unfortunately. But category 3s and 4s will not be required to provide us with average daily balances. And then I've had a lot of questions about trading book. What we mean with a trading book is as defined very specifically in our instructions, which is a direct copy from Basel. Obviously, post certain events that happened in places like Singapore, and we won't need to mention other names, trading has been an intensive focus and still is. It's actually subject to revision at the moment. Trading refers to proprietary trading. The fact that you have a position doesn't mean it's a trading position. So if you hold debt instruments, that doesn't mean you're trading them. Trading is very specifically defined as being proprietary trading. You have a trading desk. and that has got separate capital requirements. So that is what we mean with trading. If you're not clear, just, again, glance at the instructions. I think it is spelled out in some detail there, as I said. The one form that has raised a lot of questions is the supplementary data, the BR050, which is a quarterly form, so it will be applicable now in December. And I think the best way to describe to you what this form is about is to capture the logic. What we are trying to get is data related to transactions that are generated here, but not booked here. So they're not on your balance sheet, they're not part of your off-balance sheet activities, they're not part of your activities, but they are booked at head office or at another branch. What is important here is that you should have sufficient involvement to have knowledge of that transaction. So we don't expect you to phone head office on a monthly basis or quarterly basis and say, all right, how many people came here that didn't tell us? And what did they do? It must be with interaction with yourselves. So you must be part of the transaction. That is what we're trying to get at. Personnel attached to the entity. Don't think, well, it is applicable to some people in the room. This is really where you have somebody who's not based here, that is what the question is about, but that regularly performs functions for you. And what we are asking for here is an individual or individuals. So I think the best examples is typically we would not expect internal audit to be counted here, because that is a function that is outsourced either to another firm or to your head office internal audit. You probably do not have a specific internal auditor dedicated to your operation. If you do, you count them. IT could be either way. You could have somebody designated in IT that looks after you, not based here, based in Dubai. That is the sort of person we want listed here. HR, more often than not, is not a specific person. It's a department that does the HR for you. If there is a specific person, you count them, otherwise you ignore that. Turning to the balance sheet, well, the balance sheet series, accrued interest has raised a lot of questions. We do state that we expect reporting to be on a gross basis, no set-off, subject to some strict rules you may set off. But the problem that people have had is, well, what about accrued interest? Once accrued interest is contractually due to you, it forms part of the debt and must be shown as part of the debt, not as other assets. If you are accruing, for example, on a daily basis but capitalizing monthly, and that capitalization happens, let's say, on the 5th of the month, well, those 25 days that you've accrued are not capitalized yet. They're not contractually due to you. That is other assets. And that is probably one small change we will make. This series, 100 and 200, is locked down. There will be no changes to these forms until after July. And one of the small changes that we're talking about is to introduce under other assets accrued interest not yet capitalized, so that we know what that number is. But contractually due, it is part of that credit exposure. The derivatives, an area in which we are still busy writing the validations. But I thought it's important to point out to you because I've seen quite a few issues here. And there's some very interesting issues. So if you have any questions, please do contact us and let's debate them. But to highlight to you, the BR111 is about derivatives. So it includes all derivative activity, notional values and fair values, turnover, and the notional value of the transactions or of the instrument. Fair values must be included on the balance sheet, either as an asset or a liability. The problem we are finding is that people would typically report a fair value. We will find that fair value on the 111, let's say for Forex derivatives. But when we get to the 510, which is interest rate risk in the banking book, suddenly we see swaps, but they're not reported on the 111. In future, once this is on XBRL, you won't be able to submit that return because it's going to say, well, you've got swaps. So why is there no value on the 111? Typically, market risk, long and short positions in derivatives. If you're reporting something there, you need to be reporting it on the derivatives return. Net open position in foreign currencies, I think, is actually a scoping question we can ignore because it applies to everybody. Because the definition is any currency that is not Qatari Riyal. And everybody has got dollars. Everybody. So dollars is a net open position. That is, as per the IMF definition, any currency that is not your home currency is foreign exchange. The one issue we've had is there are currencies, and there's one particular one, I never can remember which one it is, which is not referred to as pegged, but it is a fixed exchange rate. Sorry? I don't think it's the Jordan one. That I think, Lebanese pounds, that's the right one, yes. It's not referred to, the Jordanian is referred to as pegged. Lebanese is not referred to as pegged, but it is fixed. It's a fixed exchange rate, it doesn't change. The Kuwaiti dinar is not. That is managed, and it does fluctuate. If it is a fixed exchange rate, you treat it as pegged. Let's not worry about the semantics. What is the logic? It is a fixed currency exchange rate. Income statement, some questions around the split of fees based on knowledge and transaction-based. What we're trying to get at is knowledge-based implies that there is the application of intellectual property. It is not just a fee that is a standardized fee, like writing a guarantee, which really doesn't take too much knowledge. That's got a standard fee attached to it. What we're talking about knowledge-based is typically corporate finance. Performance fees on funds under management, those are knowledge-based fees. They're not fixed, they are variable, they are subject to some application, we hope, of intellectual property. Sometimes we doubt that, but costs are grouped by category. A lot of people have gotten hold of us and said, where do I put depreciation? In the instructions we state, and the example I've put up is vehicle depreciation is part of transport costs. So we put it at the overhead category level. So software amortization and hardware depreciation, computer depreciation is part of computer costs. So we have the groupings by overhead type. So that is how the allocation works. Cost recovery, if there is any transfer pricing, and I'm not talking about here, interest is reported where interest should be reported. But if there's transfer pricing between yourself and head office, there is now a separate line on the income statement for that. If it is a specific cost, so if you are paying head office a fee for IT services, allocate that to IT services. What we're looking for here is typically where there's a reimbursement from head office on a cost-plus basis, or there is this wonderfully complicated transfer pricing model where you will never actually be able to figure out what it's for. You know it's sort of for all of these things, but you would never be able to split it up. Put it here. Avoid this if you can, but if it's an amorphous number, it goes there. It was meant really for cost recoveries from head office on a cost-plus basis for your category 4 type operations. But there are other instances that do fit the bill. Credit risk. This is still causing problems for a few people, and it will continue to do so. I think the important point here is Prudential reporting and financial reporting is not the same thing. And it shouldn't be the same thing. As IFRS 9 evolves, maybe they'll get closer to each other in this specific area, but your guess is as good as mine as to what that's going to look like. We do prescribe provisioning. We do not expect that to be passed as a book entry. It can be done as a memorandum regulatory reporting entry. What I would typically do is the entry and I would reverse it at year end for audit purposes and put it back on the 1st of January. However you want to do it, it is a reconcilable item between your annual report and your year-end return. We expect that to be there at all times. There has been some confusion, and if you're not quite sure, it's written at some length in the instructions. But I think the bottom line is that security and collateral is not the same thing. So where you have a property as security, that is security. Property is not collateral, by definition. Collateral is very, very tightly defined. It is pretty much cash near cash. It does include certain guarantees. But the words are not the same. They do not carry the same meaning. So collateral is defined for regulatory purposes again. Security is whatever it is. So it's important to make that distinction. We have added, and that was our omission, don't know how we missed it, but we left utilities out of the sectoral analysis. We have put it in where it should be. So it is there now. And then we've also had a lot of questions about from branches about this branch capital proxy. What we are asking for is calculate a number as a proxy. And that number is 15% of total assets, which roughly equates to what an LLC sits at based on if you go through all the risk weightings and so on. That is used for one purpose only, to determine whether or not something is a large exposure. There's no other rationale for this number. It's a number so that you know what to report under large exposures. Because the point is large exposures is not largest exposures, it is large exposures. A large exposure is any exposure that exceeds 10% of capital and reserves, qualifying capital and reserves. So we're not asking you to report your largest exposures, but only those that are specifically large exposures. And that's why branches need a number to actually be able to report. Liquidity risk, business as usual. What we are really expecting here is that there is an ALCO model, and we want you to be reporting your ALCO assumptions. Two best examples. Call deposit. Contractual mismatch, it is next day. Business as usual, it could be 6 months. It could be a year. You base it on the behavior of the account. What is your ALCO assuming? Is that money going to flow out or isn't it? That is the difference between the two. It is not impossible, but it is highly improbable that business as usual and contractual will ever look the same. It would surprise me. Anticipated change in business quarterly only is we are asking for what is your growth or possibly shrinkage expectation, and if you are growing, how are you funding it? How do you think you're going to fund it? That's all we're asking for. So it's a budget. Now, certain members of the audience might say that this is really a pathetically simple example, but I've had an incredible amount of questions about this. So I put up a pathetically simple example of what we mean with the debt instruments calculation on the market risk return. All the others, we say so much percent. With debt instruments, we say 100 basis points. And believe it or not, we've had people saying, okay, I've got a position of 1 million, so 100 basis points is 10,000. Not quite. So, you have bought a bond yielding 4%, you bought it at a yield of 3%. In other words, you paid 1.33 million for it. So, in your calculation, we now say if it moves from 3% to 100 basis points up, you would suffer a loss of 330,000. If it moves down to 2%, you would have a profit of 670,000. That's it. So it's what is the price, not the fact that it will happen, but what is the potential of that repricing. What is critically important is that it is not the same number. So 100 basis point movement up is not the mirror image of 100 basis point down. Quite different. And similarly, I'll get to that in a second, let me wait for that. Also, just a reminder, please, we do ask for the actual reporting of realized or unrealized losses as per the income statement in those categories. If you can just remember to put those in. My next point was around interest rate risk. The parallel shift, whether or not you have derivatives makes it a whole lot more interesting. But if you don't have derivatives, it is again not impossible, but unlikely that 100 basis point movement up will have exactly the mirror image effect of 100 basis point movement down. You've seen one illustration of that already, but another good illustration is if you have deposits that you are paying 50 basis points on and rates move 100 basis points down, you are not going to get customers that are going to pay you to have money with you. Would be nice, but it's probably not going to happen. We do say in the instructions, the assumption is rates will never be negative. So if you have something like that, it can only go to 0. So again, you're not going to have a flip side mirror image of 100 basis points up or down. And a correlated movement is going to be completely different. Now, if anybody wants to shout out a guess as to the correlation between 1 month and 3 month LIBOR over the past year. Gut feeling? Well, let's start on the longer end. The 10-year correlation is 0.8. That's a pretty good correlation. The 1-year correlation is 0.2. Because we've had very abnormal situations with yield curves. We've had all kinds of interesting actions by central banks, the Fed. So what happened over the past 12 months is that the yield curve corrected. But there was a lot of volatility, more so in the 1 month than in the 3 month number. So the correlation broke down completely. It's probably now going to edge back to that 0.8. But if you measure it over 12 months, it was nowhere. So a correlated move should be very different. And what we are trying to get at here is a very simple question. What is the basis risk that you are assuming? And that illustration I gave you is important. If you are funding yourself based, let's say, on 3 month LIBOR, might be 3 month LIBOR, 200, whatever you choose, but you are basing your lending on 1 month LIBOR, you have got basis risk. And a correlated risk shock will illustrate what that is. That's what we're asking you to look at. What is the basis risk that you have because you are not funding and pricing of exactly the same thing? One small issue, it's not applicable to most operations, but capital adequacy operational risk, the 630. We have amended the formula, and what this is about is if there was a loss in any year, it is excluded from the denominator, well, from the numerator and the denominator. And if it's a partial year of operation, it's also excluded. So you will only use positive values. You still report the negatives if they are there. And remember, this is adjusted. There are all kinds of interesting adjustments that are made on the 630. So it's not based on your bottom line. You have to look at that adjusted number. If it is negative, it's ignored for the calculation. I mentioned already that the amendments to the returns are largely cosmetic. And you would have, if you had a keen eye, already have spotted the one. And that is that the trading column has been unblocked. We had blocked out trading, book, interest earned, interest paid. We only had one line item for that cost allocation. However, there are operations that have got dedicated funding in the trading book. We even have operations that fund in the trading book and they fund the banking book. It happens, so we've just allowed for that eventuality. It's neither here nor there, frankly. The good news I do have for you is that the analyses sections on the balance sheet, so the analysis of deposits, loans and advances, the daily average balance has been blacked out. We do not require a daily average balance for the analysis section. We only require it for the main balance sheet items. Maybe just to, I didn't mention it at the point, why we blacked out 3s and 4s, average daily balances, was because this is really about three things: funding, lending, and proprietary trading. That's what it's about. We want to know, because we believe you should be calculating a daily balance on every loan you extend, because quite often you are charging daily interest. Maybe capitalizing monthly, but you are charging daily. So your system is doing this. It might not be capturing the data or the record, and that's where the problem usually comes in. But that is why we ask for daily averages. And then just the reallocation between banking and trading on the income statement must be zero. So if you're reallocating, yes, it should be the entire amount. So it must net out to zero. On the credit risk return, and this is really for ease of reference and the fact that we can then automate the calculation, we've just inserted a cell, what is your qualifying capital and reserve number? Branches, please use that proxy number that we asked you for. And it is because we use this to calculate percentages. So if it's on the form, those percentages are automatically calculated for you, makes life a bit easier. So instead of entering 10 cells, you now enter one, and the rest is done.
For interim financials, do we have to include the profits of the period and the capital? We have the financials of June.
The profit.
Let's say. The profit of the period, the profit from the beginning of the year till June.
Yes,
do we include the profit of the period and the capital or not?
You can include profits accrued, particularly at the interim stage.
Yes.
But you should offset any expected dividend. So in your financials, you would not show the dividend.
Yes.
Because it's only paid later. But if there is if you know you're going to be paying a dividend, or if you think you're going to pay a dividend, you should have set that already. So again, that's a regulatory entry.
Yeah.
It's not a financials entry.
Yeah.
But you can recognize the profit. The wording in the rules is must be verified profit. And generally, you would have a review of interims, and that would then qualify.
Okay.
All right. Large exposures, this is where you will see the most obvious cosmetic or look change. And this was really because of all of these changes were as we were looking at relooking the returns and designing them in XBRL and coding them. What we have done on large exposures is we had three tables, one for related parties, one for financial institutions, and one for all other. We've combined them into one table, and you've got a drop down. What is this? All right, so we ask you four things in that table. Is it a single or a group exposure? Legal entity identifier, that is the company number, the individual's number, if it's a high net worth individual. Is it a related party, yes or no? Is it a financial institution, yes or no? So that is really the change. And then there's a second table. If you had a group exposure, what is that disaggregated? In other words, what are the counterparties that make up that group exposure? And then separately, we ask for large equity exposures. If you've got an exposure, a large exposure that has an equity element, you do report that there. What we're asking about in the equity portion is there an equity exposure that in itself is a large exposure? So that's the distinction. Top part is credit. The last little table is equity. Yeah, and then we have the separate table. I mentioned that. All right, liquidity risk. Only a little bit of good news here. We've cut it down from 20 to 10. But please note that this is largest, so it is the 10. All right. So the 10 largest need to be reported. And again, we've adopted a similar approach as on large exposures credit. What is the legal entity identifier? What is the counterparty type? Which ties back to the counterparties that you see on the credit risk side. And is it a related party or not? The best news is that we have scrapped the liquidity table for Forex. So you do not need to give us a foreign exchange maturity ladder, I think was the wording we used. We decided that that was superfluous, not something we were going to use. The information we require and will use is contained in the 113. So we've scrapped that portion of the return. Oh, sorry, most importantly, is that liquidity risk now looks exactly the same as the balance sheet, not every line item, thankfully, but just the main headings. So balances with banks is an item. We haven't got those groupings that we had. The only exception being on the funding side, where deposits and current accounts is split between stable and volatile for obvious reasons. Market risk, we've also split long and short derivatives. It was one line. We've said, no, make it two lines. And again, this is a good example. Yeah, you report positives. Even in the short, it's a positive number. It is deducted in the calculation. The new forms I will send out either today or tomorrow.
Oh, okay.
Yeah. All right, first reporting in XBRL is obviously in respect to the month or quarter. For you, it is both because there are quarterly reforms, but the XBRL is only the monthly returns, 100s and 200. The business rules will be emailed to you. So you will get a copy of what XBRL will be checking. It is not a lot in the first phase. It becomes a lot in the second phase, and really a lot in the third phase. Because that is the culmination of all the data, ends up in capital, and then we have to reconcile all of those, which the system will now be doing for us. But as the rules are finalized, phase 2 is almost done. I'm just waiting for a couple of things we're discussing this afternoon, and I will even send you those, even though that's not in XBRL yet. Just to say, that's what we will now physically be checking ourselves in any case, and have been doing with the October returns and the field test returns we got prior to that. We were doing all of these checks. We did discover a few new ones as we were writing them, but they will be sent to you. Returns in Excel format will be emailed to you, and please attach it to your ESS filing. But use the file that I send you today or tomorrow, which has the required front page, which is validated to make sure that the two tie up. To re-emphasize, yes, there is dual reporting. We do call this a parallel run for obvious reasons, because it is a parallel run. Unfortunately, you do still have the statutory requirement of the existing returns. So for those 3 quarters, December, March, and June, there will be dual reporting, but we are firmly on track to switch over on the 1st of July, so that will no longer be with you. The instructions, those instructions that Rahul showed you, those references, the help in XBRL, that wording is replicated in the instructions. That's already done in the version you've got. As we finish now, in the next few days or next week at latest, the taxonomy for phase 2, we will be doing exactly the same with those taxonomy descriptions, duplicating them, we're actually linking them into the instructions. But what it really means is that the whole, well, not the entire instruction book, because there are some general instructions, but all definitions are in XBRL. So you can always look them up there, but they will be duplicated in the instruction booklet with some additional discussion like around trading book and that sort of thing. So those will come out, I guess we'd probably have it out by the end of the month. The most important part is the last point here. All data from December, all data, that which is in XBRL and that which is in Excel, will be used once we go live. We are doing this parallel run, yes, to smooth things out, but also to build up a history, so that when we switch over on the 1st of July, the supervisors don't sit there and say, right, well, we've got no information to work with. They will have a history. So it is very important that the data from now on is clean. What that means is, yes, we will continue doing what we're doing, effectively doing what XBRL should be doing and will be doing in future, validating the data that we receive in Excel. But once phase 2 comes out and phase 3 comes out, we will run all that data through the validations, because we are only human and we will have missed something, I'm sure. So at some point, you will be told, either when we pick it up or when those validations are rerun, that there are errors. Yes, we will be basing this on materiality. If you have left out $1 or $1,000, we don't care. But if it is a material error that's going to make our data and our graphs go wrong, we're going to ask you to correct it. Otherwise, we will simply transfer the Excel data in. We will keep a log of all errors, and if there's an opportune time and it makes sense, we would ask you to resubmit. Versioning of XBRL, I think it was mentioned, maybe not as vociferously as yesterday, but it was mentioned that the penalty regime obviously does not apply to the returns in the parallel run, which is great. But there is a hidden penalty. The hidden penalty is that because we are developing the taxonomy, in the future, once we have issued our final taxonomy, that version will be version 1. And anything after that, you will always have version 1 available. But during this parallel run, it overwrites the previous version. So if you forget to send us the returns within a reasonable amount of time, by the time you do send it, if you're a bit late, quite a bit late, you will suddenly be doing it in a new version of XBRL. So it could be a little bit tedious. So that's just a sort of a little nudge to say, maybe do get it to us as soon as you can. The interaction still remains. Financial analysis team, yes, Errol mentioned, we are introducing the supervisors into the process now. It's part of the education. They will be looking at the November returns and presenting to us on those returns. But issues, questions, still via the financial analysis team, please. Just to summarize the process, existing Prudential returns, all forms, are required quarterly, as you do at the moment. Nothing changes. You would have received, I guess everybody has already received their reporting schedule from their supervisor. That stays until June, and you will notice the reporting schedule only goes to June. We will finalize the rest in July. That's mandatory, and there is a penalty regime, as always. XBRL filing, phase 1, only these. So that will be for December, January, and February. Only these returns, monthly or quarterly for the Cat 4s. Via ESS, you saw the new line that has been inserted. It is mandatory, but there is no penalty regime except for that hidden penalty around versioning. And then the Excel version submitted via ESS for all other returns as applicable monthly or quarterly. I think that wraps it all up. I might just maybe remind you that you should use for the filing section the existing support mechanism. What I know about the filing system is dangerous, so don't ask me. But anything else, you're welcome. Thank you.